Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to accomplished UK fund manager Richard Penny of Oberon Investments. So, big welcome, Richard.
Thank you very much. Glad to be here again.
Yeah, well, it's fab to have you back on the show after almost actually a year. There's certainly been a lot of surprises in 2025. We still haven't finished it, but not least sort of the Trump trade tariffs back at Liberation Day, and we've had the ongoing war in Russia and Ukraine, and finally then the delayed and much anticipated budget last week. So putting all that together, what's your sort of outlook for UK equities in 2026?
Yeah, I think we're hoping for a continuation of the year in 25 that we saw running up to the budget. I mean, it's kind of been a year or two halves where actually the market in mid and small cap has been a lot better since April. I know it's been better throughout the world, but we've seen a lot more liquidity. We've seen shares going up. We've seen companies we think are cheap going up, which they just wouldn't do this in 22 and 23. So it's almost hopeless doing mid and small cap, you'd think, even though we knew they were cheap, but they would never go up. So what had changed is from December last year is that we were saying everything was cheap, and some of those scenarios have been playing out. So obviously going into the budget, there was uncertainty. People were worried about stuff that they didn't, unknown unknowns. You know, what could there be? Could there be something horrible? And it was fairly uneventful, which is good. And it leaves the way open for possibly interest rate cuts, which I think is going to be important for mid and small over larger companies. So that's pretty good. And actually the UK, surprisingly, has done pretty well against global markets. Many markets have turned around 20% since April, including AIM's done 17, the midcaps turned around 20%, the all share in the S&P. Nasdaq has had a 42% swing, of course. But the UK, you've got more reassurance around value, and it feels like UK equities in aggregate should do well against cash, which wasn't always the case in the last 4 years. And you've just got more value on your side than you do in the US.
Well, despite all the sort of like trials and tribulations, actually, the 3 years, little birdies told me that you were sort of your small mid cap fund unit trust has actually been the number one performer over 3 years. It's up 40%. Somebody was telling me. So, what's sort of driven that return? It must be stock picking, I guess, concentrated portfolio.
Yeah, it is. I mean, that's much better than the A market would be. It's a small and micro cap fund. It's just through 3 years, so we're starting to have those numbers. We've had 4 or 5 stocks that have doubled. We had Zegona, which is actually a mid cap really, but it's small cap style. It's very much a special situations, management driven. Vodafone Spain, that's gone from 150 to 14 quid, so that's pretty good. But then we've had recovery plays. We've had Aptamer Group, often rescue rights, where the price has been way too low, and in a lot of cases on the AIM market, the small and micro cap, there's been a complete disconnect from the economy. So you can get assets at really attractive valuations. So we're very pleased with that. We thought we were launching this into, about 6 months early for a recovery because we launched it 3 years ago. But the downturn the downturn in smaller companies versus large companies, it's gone on for 3.5 years. We think we're 6 months into a recovery, tentative. We think we're 6 months into that recovery, but the 3.5 year downturn has left a lot of prices, that do way below the fundamentals, and that's why we're seeing takeover bids in the small and micro cap space.
Yeah, well, that's why I love speaking to you, because you're sort of an expert in all things sort of special situation and fallen angels. We got a question from one of the companies that I think from Simon. He's asking about Eagle Eye, which is a sort of a UK champion of promotional software or personalized promotional software marketing that sell it into supermarkets and into other sort of consumer facing business. So it sells its products to people like Tesco's and Asda and around the world and stuff. It was an absolute darling, but the shares fell off after it lost a big contract. What's your sort of latest view on this, and whether it's going to sort of get some wings again to be able to become that sort of rising angel?
Yeah, we weren't in this, to be clear, when they lost that contract. The size of revenue loss, it was the biggest contract for Eagle Eye. We don't think it's repeatable. We think it was driven by some M&A that went on with a customer. It was a 10 million revenue loss, and there was a big conversion of that into profits. It's a software business. So you lose 10 million, you're going to lose a lot off the bottom line. Valuation here is under twice revenues. It's forecast to have a 20% EBITDA margin, and it's buying back shares and has cash, so no financial worries. We think the product's still very valid, and there were two things that happened this year of major importance. That customer loss of 10 million, but they've also got the product integrated with a major European ERP company. There can't be too many of those. I don't think they publicly say who it is, but you would probably conclude if you put it in ChatGPT or something like that, it would be SAP. We believe the scope for that could be somewhere between 5 and 10 times the loss of that customer, which would be 50 to 100 million over a number of years. And the product, I believe, was launched to trade in October of this year. And the company has said that it's hopeful of some contracts in Q2 of next year. So I think it's maybe designed 4 to 6 contracts. They're probably smaller than the 10 million, obviously. But in the same way, the revenue would drop through. So how would that then pan out? The company is giving guidance that it can get from its 40 million revenue up to 100 million on some sort of medium term. If it were doing that, EBITDA margins would go from 20 probably to north of 30. And if you do the scenarios and put the EBITDA multiples probably 12 to 15 times on it, you're going to get 5, 6, 7 times the price.
Yeah, no, I'm with you. I think if they can, because they've got quite a good management team, haven't they? I think, isn't it Tim Mason is ex-Tesco's? Haven't they got Sir Terry Leahy as well on the board? Is that right?
Yeah, the origins of the business was, Tesco, when they did the club card, that was a really big thing, albeit 30 odd years ago. Tesco became the number 3 retailer in the world, driven by the club card. And the back end data plumbing of that business was the origins of Eagle Eye. Obviously, they've updated it. And the main thing they're trying to do is help bricks and mortar retailers become, like Amazon or Walmart, really effectively. So multi-channel, more online stuff.
Yeah. Well, we can always hope that's going to be another Zegona. Right then. Okay, let's move on. We've got Jeff. He's asking about another special situation. NCC, a cybersecurity company. It's got 2 divisions. One, it's a consulting business that I think it's actually now trying to sell as well. And then the other division is its sort of ESCO division, which does software sort of verification. So I think it allows companies to deposit software that into this special sort of escrow facility, so that on a date they can do it on a business recovery basis. If their software supplier went bust, then they could actually recover their systems. So pretty pertinent in terms of cybersecurity. So anyway, those 2 divisions. What's the sort of the investment thesis here? Because the shares have been pretty much sort of treading water, waiting for events to happen.
Yeah, it is a special situation. It is in a bid situation. We think the value is there. Often, if you're not in a bid situation, you don't always get the sum of the parts. But the escrow business is perfect private equity. It's very recurrent revenues. I think that's thought to be worth somewhere like £300 million. And then slightly more difficult is the cyber business, which, given some of the high-profile media, clearly that's going to be a service that's in demand. The slight issue, though, is I think that's forecast to make a lot more money over the next 2 to 3 years. So the chairman, Chris Stone, his dilemma is whether to sell one bit, both bits, both of them together. But the shares are thought to be worth in the range of £1.90 to £2.40p. The issue then is if it's £1.90 and they think that they'll get £2.40 in a year's time, does the bid go away? Well, frankly, you and I have no way of knowing because it's in a process. That would be inside information. So yeah, it's very much business as usual, inline trading, which is nice because often when these companies go into these processes, they can be quite lengthy and the eye can go off the ball and you can actually have warnings. But trading has been in line. And I think there's an update on the 11th of December in terms of trading.
Right. Okay. And what did the? Because I think didn't you own FD Technologies, and they didn't have a cyber consulting business, but they had a pretty high valued AI consulting division, and they sold that off, didn't they, for an EBITDA multiple? I don't know if you can. Do you remember that one at all? And then be able to. I mean,
I remember that very well. I mean, start to finish, that stock went up 100 times. We were in that sort of £4.50. I think it went out for £25 eventually, but in 22 and 23, it was having problems with the business. They had KX Systems in terms of the UK market couldn't get its head around the volatility of trading there. It was quite slow revenue development, if we're honest. But ultimately, people in the US saw more value in it, which is a pretty repeated story. So that has been taken over. The shares, I think, traded down to sort of £6 or £8 in late 23. But I think we possibly see late 23 as, maximum despair in UK small and micro cap. Early 24 was quite bad, and then we sort of started to see a recovery. Yeah. Mid to late 24, pause for the budget, quite good this year. Another pause for this budget, and then hopefully it'll be quite good. But yeah, FDP, it just goes to show that these kind of quite growthy software IP-based assets are undervalued in the UK relative to the US.
Yeah. I was looking at NCC's EBITDA multiple, and it trades at about just less than 10.5 times EBITDA. And I think, as I say, I think that IT consultancy business for FD went about 12 times or something, or 10. I can't remember how much it was, but on that basis, then, and that's probably the least valuable out of the two divisions. So,
I think with NCC, the escrow business, you might get towards 12 or 14. As I say, you could put debt against it, be perfect for private equity. The cyber business is something to grow. I think the existing management are trying to grow it, add more services to it. But actually, that might be more of a trade purchase rather than private equity for a US player who wants to enter into Europe.
Right. Okay, good. Let's move to another unbundling. And it's very popular, actually, with some pretty smart investors, RM and EdTech. We've got Helen, she's asking about it. And I know it's got 3 divisions. One of them's a sort of like a digital assessment testing division, which has got a contract with the International Baccalaureate. And then the other 2, I think they're trying to sell off. Anyway, how do you see this one sort of playing out? But there's a lot of smart money in this stock, I know.
Yeah, well, we think it is smart money. I mean, we really like it. It's pretty good risk reward. I mean, I think there's upside to sort of £2 on 18 months. Basically, the history of it was research machines. It was a box shifter. More latterly, it moved into sort of robotic kits, B-Box, I think they're called. Those 2 distribution businesses, the box shifters are for sale, which would leave you with a software platform assessment, as you call it. That is a software platform that enables people to do the workflow of marking exam papers, i.e. assessment. And there's kind of 3 areas to growth on it. There's growth in the market itself, but specifically for the company, there is a move from handwritten scripts to digital scripts, done with a keyboard. So they get more margin and revenue for those. There is an actual AI angle where you can use the technology in certain cases, maybe borderline cases, and probably increasingly, you can use artificial intelligence to mark exam papers. So if you're struggling for sleep, and you go on RM assessment, there is a video discussing this where, they talk about the artificial intelligence marking an English language script in 30 seconds to a tighter tolerance than humans. So it's not going to replace humans, but if you have borderline cases or you get appeals, then you could probably use it as a backup. So that would be a second driver of growth. And then the third is that potentially they can use the curricula behind these English language. So this is various subjects that are done in English. So English education is exported and is used in the likes of India. So they do that with the Cambridge, Oxford, International Baccalaureate, those kind of boards. There is the scope to sell previous content, i.e. exam papers, specific questions to students. So Granny and Granddad can pay for little George and Georgina to get access to those. And then that's potentially a content play. In totality, the move to this software platform should see a re-rating. They raised the money recently, and the aim is to sell the 2 box shifting businesses. It's thought they could get 80 to 110 million pounds for those. There's 50 million of debt, and that leaves you with the software business, which is probably a 15 or 16 times EBITDA multiple business, particularly given that there's scope there for the revenue to double on 2 to 3 years, given those drivers that we explained. And that would take you to somewhere between 160 and £2. Very competent management. Mark Cook come in he was at a business called Aurelius, which is a European turnaround special sits kind of vehicle, where he ran a business called Goodtronics and did a good job there.
What sort of competition do they have in that assessment testing side at all? I don't know who else does this sort of stuff. I haven't seen any automated type, marking software.
No, there will be people that sell exam papers that don't necessarily have the right to access the content. The content is owned by the examining boards. There's obviously a partnership. There may well be some older technologies. Tribal Group do education software, but it's not assessment. There will be niche competition probably residing in sort of big US corporates, but no, it seems to be growing market share pretty well.
Good. Okay. Well, we've got another got a question coming from Stefan. He's asking about another one in your portfolio. I don't know if you want to say too much, but it's Inspecs, which I think is a company that's been through trials and tribulations, and I think it did just recently get a bid or a sort of like a provisional offer for it. But anyway, any quick thoughts on this one?
Yeah, about a month ago, they stated that they'd had two approaches. They're not formalized bids, and then a trade by a Safilo interested in one of the divisions, and that process continues, and there's been extensions in the bidding process. Inspecs, if we took the graph back further, would have been as high as £4. It's difficult because the investment performance has been, well, it's certainly been mixed, hasn't it? But there have been headwinds in Germany from the Ukraine, that kind of things, but also the execution and the conversation with the stock market has been, they've tended to miss their forecast, frankly. And so that was quite correct that the share price would come back below £1, but at 40p, it seemed far too low for a business that has some really strong trade brands in Germany. So you've got Humphreys and Titan Flex, which definitely have value. You've got a new factory in Vietnam that they've just built. You've got a business, Tura, in America that I think does somewhere between $5 and $8 million EBITDA standalone. And it is possible to see an assessment of the value. There was an open letter that I think is available from a business called Siegel, which is a hedge fund based in Norway, I believe. And I think they came out with a price range of somewhere just north of £1, putting various values on the Eschenbach subsidiary that was bought that includes Tura, and a value for the business that floated 4 or 5 years ago called Killeen. We'd be sort of same sort of ballpark as them. We'd probably have more in for the Killeen business because I think there is now upside to that from Vietnam. That's a pretty strong alternative to Chinese production. And then the Eschenbach business we might be slightly lower on because there has been difficulties with that. They've bought it and they haven't really integrated it particularly well. Yeah. But that sort of £1 to £1.10 feels like the right sort of number. If a bid came in at 80 to 90p, then that might cause a dilemma for people because £1 might be fair value today, but you could see how the fair value could come up. And the alternative, of course, is to see a management team, either the existing one or another one, turning around and running the assets a lot better than they have been.
Yeah. Well, hopefully we should get a result fairly soon in terms of whether it's an agreed bid or an offer or something like that. Anyway, okay, let's move to another sector. Let's go to the housing sector. Again, through it's been trials and tribulations. We've got Tony. He's asking about one of your. It's a big cap, Bellway, one of the big national home builders. We haven't had much support from the government in the budget, and obviously interest rates are still a bit high, so it's made affordability a bit tough. But how do you sort of like view the house builders over next year, and then particularly Bellway, because it trades at I think it's about a 10% discount to net tangible assets.
I think it's yeah, we don't know quite where assets are going to be. I think it's between 0.8 and 0.9 times NAV. Usually that's a good time to buy these things. This year, of course, rate decreases have been somewhat delayed, particularly by the budget. But it is thought that there might be 2 to 3 quarter point reductions at some point in the next 6 to 9 months. And I think there is scope for perhaps a stronger improvement in the housing market out in H2 of 26. H1 is probably a bit unrealistic. But certainly there's a lot of companies that sort of hoping for that. So on that basis, Bellway for us, most of the house builders will trade pretty similar. It's obviously dependent on the housing market, and really looking for that decline in interest rates with a 0.8 times book looking pretty good.
What's the dividend yield on these things? Is usually pretty good, isn't it? It's what? Yeah, I know it's about 2.5% actually, but what PE ratio?
Yeah. So Bellway grows more strongly. There is a prospect of they've got a good long land bank, and they are generally strategically looking to increase the number of houses built. If you want yield, then you can go for Taylor Wimpey, or I think to some extent Persimmon have got close 6, 7, 8% yield, but they grow less.
Yeah. Okay. All right. Good. Well, in the same sector, well, but further down, we've got in the aggregates business, we've got Emma. She's asking about Breedon, which does, I think, sort of asphalt and tarmac and cement around the world in the UK. Bit of a buy and build. Got a business, I think, in Ireland, and then did do an acquisition just recently in the States as well. How's it currently trading, and what's the sort of the outlook for this business going forward?
Yeah, so you're right. Recent acquisitions have been in the US, so there's been a pivot to the Midwest. They've made 2 acquisitions there, and there's pretty strong growth there, and it's quite a nice area that's less contested. The big US companies are in California and Miami, Georgia, these kind of places. The Midwest is a lot less competitive, but actually has good growth. Shares have been poor because that the interest rates are sort of an issue, but sort of cement and aggregates is more about infrastructure. Believe this or not, in the UK, quite a lot of infrastructure projects have been sanctioned, but they are kind of in local authorities, and by all accounts, central government is struggling to release the cash to the local authorities. You'd struggle to believe that, but that has been a headwind this year. I think cement volumes are at levels only last seen in 1961, so it hasn't been a helpful market. But this company, aggregates, it's quite difficult to get them permitted, and there's definite value in that, and so these kind of levels, we just think it's an option on an improving market. And from a valuation point of view, I think the value of the aggregate reserves is comfortably north of about today's price, but the downstream activities in ready mix concrete and cement and asphalt would not be included in that. So we think it pivoted when it did the Midwest, the American deal. We think that can be an area of growth. We think this is pretty good point to enter these shares.
Yeah, it's quite a consolidating area, isn't it, as well? And it wouldn't surprise me if somebody in private equity wanted to do a roll-up in this sort of area as well.
Yeah, I mean, it's a trade for the patient. If you're looking at the last year, somebody would say, oh, they always find bad weather, and they did have bad weather last January and February. Then they've had, as I say, there have been delays in infrastructure in the US and the UK, but at some point, it's not going to remain as bad as it's been. If we're at the lows of since 1961 in cement, at some point that gets better.
Yeah. Okay, good. We've got Steve Waters. He's asking about, and I don't know whether you can talk about it, but Kooth at all. It's basically a mental health software business that won a big contract in the States, about $300 million for 5 years. But the market is a bit sort of wary about whether it's going to be renewed next year, hence the shares have sold off. But it's the number one and dominant position in the UK, trades at a ridiculously low value. I don't know if you got any quick words you could say on Kooth at all.
Yeah, the one reassurance I would give on that is that the shares are probably trading lower than before they won that contract, and there is definite value in terms of what they do. The payback for health systems in terms of allowing people to use the apps that they have, which is for mental health for people between 8 and 18, I believe. The paybacks are really strong. So in reality, health services should be using this, and the metrics have been a lot better in California. But as you're right to point out, California, we have no way of knowing whether or not that will be renewed, but they have had reasonable traction within that.
Do you know what? Do you know why they haven't won any other sort of follow-on contracts from the California? Given it's such a big statement agreement. Yes, they did win that pilot out in New Jersey. I'm just scratching my head, given it's 3 years now or 2 years since they actually inked the deal. Why they haven't had a sort of like a number of these contracts?
Yeah, I think it's in the US. It's going to be interplay between national politics and state politics. If you get any change between Democrats and Republicans, you could see how Trump would be. He probably would define anything to do with mental health as a bit woke. And
Really?
it's an interplay between those two things. I mean, clearly there is huge increase in need for these kind of interventions on mental health, particularly since COVID. And as I say, the paybacks are pretty strong, but it to some extent that may become a bit of a political football, and there have been changes at state and also national level in the people making the decisions.
Okay, good. Well, let's move to another one. We've got account Rudolph, and I don't think you own this share, but so please don't say anything if you don't want to. It's basically Big Technologies, which does sort of like prisoner tracking devices, the electronic leg tracking things that allow prisoners to come out of prison and then be prisoners at homes, or sort of captive at homes. But if you ever had a look at it, I know the shares have done poorly because they've had this big outstanding litigation with their ex-CEO Sarah Murray.
Yeah, no, it's a good business. It's a very recurrent revenue business. They didn't win so many contracts. They were hoped when it floated. They were hoping to win contracts, which they haven't. They were hoping to do acquisitions, which again they haven't. And then, of course, as you say, you have the litigation. There's other really cheap things to buy. There's many other cheap things to buy. It could well prove to be very cheap, but I'm not up to speed with it at the minute.
Yeah, I would say Rudolph, that the actual have a good look at the potential liabilities with that litigation, because there's quite a few public legal documents now available. And from my last understanding, I think the maximum potential value at risk is about 320 million pounds, which is more than the market cap of the company, which is why it's acting as a drag, I think, on the share price, given that there's a lot of moving parts. If anywhere near that number has to get paid out. Okay, good. Let's move to a company that's came out with a number. Came out with sort of like a quick update today. We've got Easyjet, the low-cost airline, set up originally by Stelios, I believe. Anyway, it does obviously low-cost flights around Europe, sort of like a copycat of Ryanair, but has also got quite a big and booming holidays division. What's sort of like you attracted to this? Because the shares have actually come down. Well, they're very cheap at the moment.
Yeah, they're very cheap. We bought them recently. I mean, I think the reason why they've come back is the consumer has been weak around holidays. We've seen some comments from the likes of Jet2 and Ryanair. The reason for buying this one, although intuitively it's not everybody's favorite airline. I mean, everybody likes the cheapness of Ryanair, or they actually like to get on Jet2 planes,
Yeah.
and I would agree with that. With Easyjet, the reality is they have a lot of these narrow-bodied jets. They have the landing slots at Gatwick and everywhere else, and that's just difficult to replicate. We have, to some extent, there are supply chain issues in narrow-bodied aircraft, and actually you're seeing certain of the carriers buying second-hand aircraft at quite very attractive prices relative to book value. So just if you take Easyjet, let alone the profits, and you look at the assets, you would get a comfortably higher price. And even the management of Ryanair is saying that potentially what happens with this is that somebody would buy it for its slots and its aircraft.
Yeah, it's only trading on about 7 times PE, and it's got cash on the balance sheet, doesn't it? So it seems, yeah. I mean, it looks wrongly priced, assuming that there's not going to be a really deep recession that stops people traveling, or there's another pandemic around the corner.
Yeah, prices are much higher now than they would have been 2 or 3 years ago. I think they will stay that way, because if the airlines cannot get access to these, the 737s or the A320s, which they can't as long lead times, less planes go in to compete against people, and then that argues slightly for higher rates. And people, ordering has been slower around holidays, but people do prioritize holidays over most things. And the issue with it, I guess, is Ryanair has been brilliant over many years. Jet2 has been a 100-bagger if we look, and has, is very shareholder friendly. EasyJet, sort of, if you're making a decision, you probably don't get past those other two, but as you say, it's incredibly cheap.
Okay, good. In the same sector, we've got SSP Group, which basically does all the restaurants and cafes in railway stations and airports around the world. The shares actually a similar sort of thing, have really been sort of like, on a very low valuation for historical. Is that sort of like an opportunity for people who have a bit of a longer term view? What's the investment thesis here?
Well, it is, because actually this has changed quite significantly in the last year at several levels. They floated a business called TFS in India. So the demographics and rising incomes, rising middle class in India, airport lounges, and catering is a lot stronger, and that's floated. They own 50% of TFS, and that is thought to be worth, well, it is worth, if you multiply the number of shares that they own by the price today, it's worth somewhere between 85 and 95p. That puts you into the rest of it for not a lot of money. Now, they've also been through a capital expenditure program, which has sort of come to an end. There's also a change in LTIP, where management are much more incentivized about return on capital. And so we started to see a buyback of £100 million this year. There is also, within the UK and European businesses, the European business, particularly in France and Germany, is a turnaround situation. They've got about 1.2 billion of revenue, where they're making a margin of about 2%. There is scope on a 2 to 3 year view to get that to 5%. So there should be earnings growth. There should be excess cash, because CapEx has come down. And at some point, you would see a further buyback if they were to sell down some of this TFS stake, which, as I say, is 85 to 90p a share. So with that being valued at sort of 20 times EBITDA plus on a standalone basis, and the UK and European business probably on an EV/EBITDA multiple of 3 or 4, there's a clear sort of corporate agenda to sell down that TFS at some point and maybe retire shares. The market looks at it and goes, is it an upgrade? Is it a downgrade? What's the prospects for, how are WH Smith's doing, how are regional airports in the US doing? But the reality is this TFS float is a major thing that the market just hasn't onboarded.
Yeah, and it's possible to sell down that sort of stake out. Is it in India? It's listed on Indian stock exchange, is it?
Yeah, I think it floated 3 or 4 months ago. In time, if there's demand, it would happen, and they would sell it progressively, I think. We saw a similar sort of thing with Aberdeen, and they had stakes in India that they sold down progressively. The Prudential, I think, is selling stakes in asset managers out in India. The reality is the UK is undervalued, and people ask what the catalysts are. Sometimes it's takeovers by private equity or corporates. Sometimes it's people taking assets and floating them on other exchanges, and TFS would be a case of that.
Yeah, and there wouldn't be any sort of capital gains or currency controls coming out, because if you basically got a shed load of Indian rupees and you've made a big profit out of it, I would have thought the authorities would be all over like that like a rash.
Yeah, that would have to get a further update on, but
yeah,
the analysts seem to feel that the value is 85 to 90p. I'm sure they've done their work on that, but I would seek further assurance that it is the case. They're worth 85 to 90p.
Yeah, good. Okay, let's go for another one, which is going for a special situation. We've got Steve is asking about Spire Healthcare, which is the UK's #1 private hospital operator. It also does healthcare centres, I think. Getting obviously a bit of a boost from the enormous backlog of elective procedures, the NHS waiting list, plus increases in own pay, insurers, and all this sort of stuff. But and they just put themselves up on the block to be sold. What's your sort of like your view on whether the transaction's going to happen, and if it doesn't, what sort of the outlook is for the business?
Yeah, so it's reassuring that there is this process where they said they've had early approaches. It's not in a formal bid process, I don't think. There's an awful lot of freehold property in this because they own a lot of the hospitals behind the private healthcare. And they also own an occupational health business that's doing about 10 million of EBITDA, but it's got runway to 40 million. And I think you can see that on their website. They talk about that business at length on a central markets day. If you add up the property and the various operating divisions, you can get somewhere between £3.20 and £4.50. Now, it's quite possible that somebody might put a deal in at 280, which is obviously very attractive compared to today's price, which is 224. But the board might turn it down because they might be very confident that it should be worth 350 or 360. And if they then refer that to certain shareholders, they might say, well, actually, we will stay and we'll stay for 360. But then the bid could fall away. The share price might come off a bit. But actually, you would have that confidence then that the shares are worth comfortably more.
Yeah. And when do you think a result will be, or the outcome of the potential, sales process will occur?
It's sort of how long is a piece of string, that, because if you've got 2 or 3 bidders, you want to keep all of them at the table. If you're an opportunistic bidder, or you want to pay a lower price, so you have to keep everybody in the process until people come up with a concrete bid, which we haven't been updated on that, and we won't be. So it's not possible for us to know that without being inside, which we are not.
Okay. All right. Cool. In the same sector, we've got Chris. He's asking about One Health Group that I know you've talked about before. Came out with, I think it was the first half results today. Seemed to be pretty positive in line. Shares have done pretty well. Must have done pretty well since you bought them. What's your latest quick views on One Health Group?
Yeah, the business has done very well actually since it's floated. It's not really missed any forecasts. They basically allow people to go for an alternative to your. Is the internet still working?
Yeah, it is. Yeah, no, it's just all right.
All right, good. Yep.
Yep.
They allow people to elect to use an alternative provider of a hip and knee replacement. 3 or 4 different areas they use, and that business has done very well with the NHS. Obviously struggling with large waiting lists, so they've hit all of the numbers there. They basically will hire private facilities and then employ all the doctors who are free to work 2 or 3 days a week, not in the NHS. And the latest thing is that they're going to build their own facility in Scunthorpe. And I think they're about a year from that coming in. When that comes in, there should be a very good short to medium term uplift in profits, reflecting an £8 to £10 million build value. But they have the cash. There may be delays on the rollout of that because they're subject to local authority planning. But that could basically mean that the business is really quite small, could actually be a rollout of these kind of facilities. So there's various parts of the country. That's in Scunthorpe, as I say, but I think they have their eyes on one in Bradford. All places I know you like to go on holiday, Paul.
Yeah, lovely. Going for curries in Bradford, fantastic. I've been there a few times. But just in terms of One Health Group, what's the sort of the pricing power that they have? Because I think isn't all of their turnover come from NHS trusts, and obviously they're employing, or not employing, they're contracting consultants from the NHS to work on their own account privately in. I think do they do the operations in people like Spire and Bupa, those facilities? They don't do them in.
They do, yeah. So their pricing power, they get a rack rate, which is a reflection of costs in the NHS, which tend to go up around labour costs. So if nurses' pay goes up, that's good news for them, and they're clearly making a good margin on it. And the doctors are clearly happy to go and do 4 or 5 operations in a day on a Saturday there, because they're getting paid quite a lot of money for it.
Okay,
so it's basically they're able to operate, be more organised than the NHS, which I'm sure is possible.
Because I know with Spire, one of their profit warning they had, I think, at the start of the year or back end of last year, was because they couldn't actually pass on the NI and the higher sort of minimum wage levels into their contracts with the NHS immediately. There was that delay, and therefore, if they got squeezed effectively by the NHS, that's the only risk I can see with the One Health, is that essentially the NHS becomes belligerent, if it ever did do, and decided, right, that's the rate, as they did with the domain sort of effectively the OA people residential homes years and years ago.
Yeah, I think with the likes of Spire and they're obviously running the hospitals all the year round. With these guys, they're taking the operating theatres for a Saturday or a Sunday and operating them. The national insurance cost, people on the minimum wage is not going to be such an issue. They're not necessarily employing all the cleaners and the people pushing the trolleys around. So there's less of a minimum wage issue. And as I say, the uplift in the junior doctors' pay and the nurses has been helpful in mitigating some of that.
Okay, good. Okay, we'll stay in the same sort of sector, but come down the food chain a bit. We've got Verici Dx, which is basically a specialist in organ transplant or kidney organ transplant diagnostics, and we've got who was it? I can't remember who was it. Basically, it was David. David was asking about it. So I was just wondering what your latest thoughts here. They've raised some money at the start of the year, I think, or this year.
Yeah, it's one we were aware of for some time. They did a rescue rights at Halfpenny, which is unfortunately, with the market we've had in the UK and AIM, and particularly in companies under £200 million, there have been companies that went into the downturn with 2 years' money. The downturn was 3.5. There are quite a lot of companies that have to raise money at the wrong price. We think Verici is interesting. We think it was the wrong price. They've got 2 diagnostics that are approved, that are rolling out. One is for diagnosing whether or not somebody might reject an organ transplant, and one is for after the event. There's also third-party people, Thermo Fisher, we've got to tie up with them. I think this was refinanced at a pre-money valuation of £2 or £3 million, which is really low compared to the money that's been put in it over the years. We thought they were making enough traction. We think there's, regulated products there. It's taken them many years to get those regulations. We thought it was a really good risk reward. Yeah.
No, I'm with you. If they can actually deliver those the orders from the transplant centres going forward, then you should see a significant uplift in certainly in their financial results, and hopefully in their share price too. Okay, good. Let's move on to another sector. Let's go to one you've mentioned. I think it was your top pick last year. We got Roy is asking about distribution finance capital, which gives loans to dealers of I think it's sort of like power sports and caravans and all kinds of sort of those type of activities, not only to dealers, but I think to consumers as well. Anyway, the shares have responded very, very well. How do you see this one going forward? Because it's obviously performed very well for you there, Richard.
Yeah, I'd say it was very small a year ago, and it's still quite small. It is a small bank. Put it in context. I mean, the shares today are 50p. I think the low point probably more than a year ago was 20p, but it's always traded at a discount to its NAV. Where that starts to become interesting is that the net asset value now is growing. So 50p, so it's 70 pence. So 50p plays 70p. In July, they commented that they were trading well ahead of expectations, and they've done the difficult thing now, whereby people were very excited about this business when it had 200 million loan book and it was loss making. The shares were £1.20. Given the nature of the market, of course, now that it's actually happening. They are nicely profitable. Every extra 100 million of loan book is probably dropping 4 or 5 million onto profit before tax. And so it just feels like, having grown the loan book from 250 to 700 million since 2000, we are going to see loan book growth. We're going to probably see the net asset value get out towards £1 on 3 years. And there is, I suppose, a hope that a small bank might actually be able to trade at a premium to net asset value if the return on capital, as you would expect, goes up beyond 15%.
Who do they compete against in this space? I mean, is it really sort of white space? Because I mean, I don't know many banks will give a loan to get your caravan.
It's specialist lenders. So and actually, to some extent, the larger banks have kind of pulled out the specialist areas. To put it in context, the chief exec came from Aldermore and GE Capital before. And it's a kind of model that the likes of GE Capital have used in the US. So the special thing about the lending they do is they've got, if you like, a triple covenant. So if they're lending to somebody to finance an asset on a fork or a motorcycle or something like that, they'll lend at 50% loan to value on the asset, and they'll have a covenant over the dealer whose business it is, and then there may well be a further underpinning from the OEM, the maker of the motorbike or whatever, the Ducati or whoever it is. Yeah. So their loss ratio has been really low. So that's always a factor in these specialist lenders.
Yeah. So basically, what you're saying is there should be, and even if it went through a downturn or recession, they should be their quality of their loan book should be reasonably resilient, because there's a lot of ways of recovering the asset value.
Yeah, so in a bit of a consumer downturn, the assets will stay on the forecourt longer, which basically means they don't have to replenish the loan book so much. Clearly, if the assets become a bit long in the tooth, you worry about the dealer's solvency and how much, whether you're going to have a bad loan or not.
Okay, good. Let's move sectors. We've got Amanda. She's asking about. You mentioned it earlier on Zegona, which has obviously been an absolute rocket ship. It's a star for you, because I think when we chatted 3 years ago, and that was one of your first sort of like major sort of like purchases, then you said it was going to be one of your favourite stocks. Well, it's done more than that, and it's gone up. I think it listed at about £1.50, and I was just looking at the shares now; they're just over £14. So it's 9 bagged. Fantastic there, Richard. What's your latest view on Zegona? It basically owns the Vodafone Spain telecommunications company, obviously out in Spain.
Yeah, so the update here in recent weeks has been that they should complete transactions to sell the network. So they have two partnerships with Orange and Telefonica to aggregate telephone assets, and infrastructure funds will then buy these assets because they're very attracted by a monthly recurring revenue. And those are much more highly valued assets than telecom businesses tend to sell for. This whole process brings 1.8 billion euros of cash into Zegona and enables them to pay a special dividend, and critically to retire over 60% of equity that sits with Vodafone, which was part of the original transaction, I think, in Q4 of 23. So this has been relatively quick performer, but clearly by retiring 60% of the equity to Vodafone, that is a huge kicker in terms of performance. The subsequent benefits would then come from whether they can improve the actual operating metrics. There will be some improvement. There's quite a lot of debt in this business. They bought Vodafone Spain with over 3 billion euros of debt. By getting this cash in, by improving the operating metrics, they can probably pay a little less on their debt. And there is a debt into equity transfer. It is entirely possible that the shares, if they trade in line with other assets, would trade up north of £20, which is pretty good from £14. We have reduced the number of shares we owned quite substantially, over 50% reduction in the shares, just because it's become such a big part of the portfolio. But yeah, there's still good upside in it, and the business is run by a very good management team within telecoms. Potentially, they might do other deals, I suppose, but yeah, we still see reasonably good upside, albeit not 8-9 times.
Yeah. Well, I remember saying when we chatted about it 3 years ago, the investment thesis you spelt out has played out perfectly, because you mentioned you were back in a great management team and you saw value in that fixed fiber network, and eventually it would be bought out or pushed into other joint ventures with infrastructure plays. And it's happened perfectly, and it's released a shed load of capital. So I tip my hat to you there, Richard. I don't think you should go into sort of like I don't know, telepathy or predicting the future. Would be very good. Okay, right. Let's go to one which hasn't done so well. Chemicals company specialist Victrex. We've got Matt asking about it. It does peak polymers. It's really been hit largely by depressed industrial markets. Peak polymer is a lightweight, high performance plastic that goes into really quite difficult conditions where heat and strength are very required, and lightweight. But anyway, what's your sort of view on Victrex? Shares haven't been so good, actually.
They've been poor, yeah. It's been really poor over the last 2 or 3 years. The most recent story has been that the medical area, their plastic products will go into back implants. They've lost some market share there, and that's been going on for 1 or 2 years. It's obviously very low weights of the product, but they get more royalty and licensing for it. They've also been doing some investment in China. The cost of that has come on, and there's been capex for that. And that's to some extent depressed profits. Industrial markets, as you say, have been difficult in semiconductors, aerospace, these kind of areas. And you know, the capex has gone through the peak. Yes, and so capex should come down. Business is pretty cash generative, even on lower profits, and it's yielding about 8 or 9%. So I think we would probably persist with it, even if there hadn't been a change in management. So we have seen a change in management, and sometimes in a downturn, as we have seen, you do get changes in management which you wouldn't otherwise get. And the new chief exec is coming in from AB Dynamics. Obviously, AB Dynamics was a very good business for a long period of time. Victrex has been difficult, but bringing a sort of fresh pair of eyes to it, with a sort of increased cash profile, and hopefully the industrial market getting less bad. We think at 9% yield, you're getting paid to wait.
Yeah, no, I would agree. I mean, for a quality business, I mean, it makes 18% EBIT margins and trades at 7.5 times PE. If it can get some growth going. Do you know, just on that top line though, do you know why it's been losing market share in that spine category of the healthcare?
Yeah, I think Peak's been losing to 3D printed titanium. I understand that potentially 3D printed Peak there could be a comeback there, and there have been product launches. But also I think there have been difficulty in US healthcare as well, around budgets and those kind of things.
Right. Okay, good. Well, just exactly. Great segue then into 3D printing company Xaar. We got Robert asking about it. This has been really been around AIM and the markets for ages. And it basically has got inkjet technology that allows viscous fluid to be printed on various things. But its latest real growth driver is doing 3D manufacturing or 3D printing for manufacturing, maybe even for spines, titanium. I don't know, but what's your sort of latest on this? The shares have ticked up nicely of late.
Yeah, they have. They were at sort of 75p, which was below the cash and the working capital. It's a very clever business. They actually have about 45, 50 innovations they're doing. So it tends to be that these printhead goes into machines that make things. Well, machines that make things are very cyclical, because when you get a downturn, nobody orders any more machines. We saw this in 2009, between 2009 and 2012, I think it was. Their application was used for printing patterns on tiles, and you could do a higher definition. You could randomize it because it was digitally driven. And they took massive market share there, and that was 100 million end market. Their profits went from 4 to 48 million. Sorry, EBITDA rather than profits specifically. We think of the 47 technologies now, there's probably 3 that have that 100 million potential. So you're right, 3D color printers, there's a product coming out there, which is coming out at 10% of the price of the professional product, that may find appeal in the education and hobbyist market. There is coating electric batteries, where when you move to 700 volts, you need to coat with a different fluid because the other ones break down, and that can be dangerous. That has been extensively trialed in China, and we think is a when, not an if. Whereas a year and a half ago, we wondered whether that would come through the trials. So that's reasonably reassuring. So this is making machines for people that making the print heads for people that make the machines for the BYDs and these kind of guys.
Yeah, that'd be great. Be great to do 3D.
You drive it there as electronic vehicles.
Yeah, 3D. Sorry, go on.
No, you go.
Yeah, I mean, certainly doing 3D printing for schools or for R&D, sort of like design and this sort of stuff, would be absolutely fabulous, because you sort of like get a little kid to be able to put together some sort of figurine, and then he presses a button and he suddenly appears in front of his desk. That would just light his eyes up, wouldn't it? It'd be brilliant.
You can scan something with your iPhone, and then you send it to the machine, and in theory it will make you a little copy of it.
Right.
And I said there were 3 things, just for completeness. The third one is printing details on cars. So you could print go faster stripes or decals. At the minute, that's about 1% of the market, is where you take it off the production line and you put these features on. But in fact, it could actually be used for things like custom paint jobs. You could fade the colors, etc. Pretty much to demand. And that's been heavily integrated with the leaders in paint robotics and the paint systems, Dur and Axalta. So this has been many years in development. Obviously the car market's going to move slower, but potentially that's huge.
Yeah. Okay, good. We've got Neil. He's asking about Mincon, which is basically the rock drilling business. What actually does it do? Is it for basically metals, sort of like mining and construction, or is it for more sort of oil and gas? What's the sort of products are used for, and what's the sort of investment behind it?
So historically, it's been for mining. If you're mining hard rock, then you have a wear part that you make a hole and you put the drill bit down it. So it's the wear parts for that. Clearly, the market will pay more for more quality products, but also it's useful for piling on construction projects, which is an increasingly strong market for them. Throughout this year, they've been commenting about a recovery in the markets, which is interesting in itself. It's about 120 million revenue, 120 million euro revenue business, seeing a recovery. They're taking some cost out. That's nice. But where it gets really interesting is a product called Green Hammer, which is where they use a hydraulic rather than a pneumatic product, which gives you more energy at the point of the interface with the rock. And basically, it's 55 to 60% more productive if you can do it. It's been a bit of a holy grail. The share price was 120 when people thought they could do this 3 or 4 years ago. It's now in field with Atlas Copco, and it's been used in a copper mine, I believe, in Arizona. And so there's the addressable market here is sort of 1,000 rigs in North America, with the addressable size of the market is some 15 times their existing revenue.
Yeah.
So the share price is a third of what it was when people were excited about this. It seems to be happening. It seems to be robust. It seems to work. It's not going to be an overnight success, but potentially it's totally transformational.
Good. Okay, we got a question from Lorenzo. He's asking about Gamma Communications. Do you own this one? It basically does, I think it does communication systems for contact centers, largely in Germany and the UK, I think.
Yeah, it does. It's a variety of telecom services for sort of small, medium enterprises. Traditionally, it's been in the UK. It's been a great grower. It's got very high return on capital and growth. It's sort of struggled a little bit with the SME narrative in the UK around the budget and the UK economy. But actually, the bigger feature is that it's gone from AIM to full list. So that's meant that there's been a big turnover of the shareholder list. The German market is very interesting because it's a bit like the UK market would have been, say, 10 years ago. And there is scope for them to basically see the same sort of growth out of Germany that they've seen in the UK over the last 10 years. So they're certainly targeting that. Yeah, it's a nice steady one. It's just got all the right sort of financial metrics you'd want: high return on capital, high cash generation. You should see dividend growth, and its valuation is about less than 10 times EBITDA, pretty low PE. It's traded at sort of 40-50% higher levels. We would expect in time the rating to lift up a bit if we can just see a little bit of a recovery in UK SMEs.
Yeah, I've got sort of like less than 7 times EBITDA actually for Gamma, but I guess the question that I would have is, where's the growth coming from? Is it going to be through M&A, or is there any organic? Because contact centers must be under pressure from generative or agentic AI in terms of people basically going forward purchasing items. They can just ask their chat GPT agent to find the cheapest, I don't know, basically sneakers or mobile phone, and then it will come up with a number and it'll come out where you can buy it, rather than having to buy something straight through a call center.
Yeah, I think it's traditionally it's more been telecom services rather than call centers, and it's more fixed lines and broadband, to some extent mobile services. Right. Yeah, they may well do. They may well give you a virtual receptionist. If you're a small, medium enterprise with 6 people, they'll do call routing, but it's not really call center per se. It's more telecom services. And yeah, to some extent, of course, it's moved from fixed line. Everybody used to have a fixed line telephone to more internet-based stuff, but they're very much involved with that as well. There's the ownership of the relationship with the client, and the client will still demand these services. But there's often no in-house expertise, and they just want to add the various services to make the telephones work in one way or another.
Brilliant. Okay, well, we've come towards the end of the interview, but before we close, given your record, actually, Richard, which is fabulous, and your sort of like suggestions for the top stocks for for the following 12 months in the previous 2 years, and we had Distribution, Capital Finance, and Zegona. This is where everybody's at bated breath. Where do you think there's some really good opportunities that people should have a good look at themselves and do some research over, that you think could do pretty well over the next sort of medium, 1 year, 2 year, 3 years?
So an area that's been totally hit, rightly given the difficulty in the small and microcap market, is the sort of small healthcare stocks. And there's a number that I would point out people might look at. They probably haven't been looking at these at all because there's a preference for dividend stocks and very well financed, but ones that catch the eye that could go 5-10 times, and you need to buy a range of them. And don't blame me if you buy one that doesn't. But, I'll give you 6 names. So we've had Verici.
Yeah.
So we've mentioned that. A sister of that is Renalytix, which is renal disease. Aptamer, which is synthetic antibodies, which has actually been a good performer for us this year. Oxford Biodynamics, which is brilliant science, but has struggled over a number of years.
Is Oxford Biodynamics the one which does gene therapy, or is this a diagnostics business?
So MaxCyte does gene therapy. Oxford Biodynamics has got diagnostics. Actually, it's got a PSA test, but amongst other things, Arecor, which has got ultra fast acting insulin, that looks really quite interesting. Particular tie up there with a business called Sequel, which invented insulin pumps. That could be really interesting. And then Creo, which is kind of medical devices. They just had a central markets day. Again, a really interesting product. Commercial traction has been slow. It's quite costly to run a sales force. Ultimately, the medical devices they've got enables you to treat pretty untreatable conditions at the minute. Things like pancreatic cancer, you can do lung cancer. They will be able to do in 30 minutes, non-invasively, as opposed to sort of 4 or 5 hours having cut people open. So Creo, at some point you see somebody paying multiples of the price to take it over because they will put it through their own distribution pipeline. So it's been these. So we've had a downturn in small caps, which lasted 3.5 years. It's these sort of companies that have been exactly wrong to own. But if we get any kind of recovery, they are fundamentally way too cheap for what they are. And if we get slightly better investor engagement, you can see very, very strong share prices sometimes in some of these names. But as ever, mind your eye, do your own research. But I'm quite drawn to all 6 of those. So
just on Creo Medical, is there any way of actually moving the needle significantly, either on its cost base or its revenue? Can they do so? Is there structurally something they can do? Perhaps outsource?
So there's more and more instruments. There's more and more procedures they use the instruments for. So you have multiple instruments times multiple procedures times multiple geographies. So to put that in context, one of the early products is in lower gastrointestinal in the UK and Europe. That will get approval in the US at some point, but it will also get approval for other indications, so other procedures. And so they'll get more and more surgeons using it. There's also, I understand there is a family of products. So you have sectioning, resectioning. Basically, you cut and you blast and you remove stuff. The different instruments for both. And the real USP for what they do is the instruments will go down an endoscope, so you don't have to cut people open, which is transformational. And there is a skill to that in terms of how you use microwaves and radio frequency technology. There's never been any doubt as to how clever the technology is, and the share price was up at 300 million market value at one point. It's just, as you say, the traction, but there will be more traction. It will get deployed on robots for lung cancer with Intuitive Surgical, which is a $180 billion company. It's quite important for them, actually. You can put 1 or 2% growth on a $180 billion company. That's incredibly valuable. Company's valued about 45 million, which is the value of its cash and the distribution business that's profitable they've got. Effectively, you're paying nothing for the technology. You're paying half the price the chairman has paid. Put £1 million in it over the last 12, 15 months. He's put $1 million in at 21p there, 10 or 11p.
Yeah. It seems like an absolute crown jewel asset in life sciences or medical devices that really needs to be owned by a much bigger medical devices firm who can commercialize that technology on a far faster track and remove a lot of the duplicate overhead on a consolidation, and then I think it would realize a lot of shareholder value.
Yeah, it is. I mean, the cost of running a sales force is very expensive. The people, usually the value to any of these devices, diagnostics, is in the US, and it usually costs you $200,000 to $300,000 per head, which is a lot more than a person in a white coat. So when you get into the sales mode, for 6 months before they don't sell anything, you're carrying a lot of expense. But the reality is you have people that have got huge sales teams that carry multiple products where you could slot this in and it'd be hugely incremental to them. It's worth their while to pay a lot more money for these kind of names that we mentioned.
Brilliant. Okay, well, thanks again, Richard. Great 6 sort of small cap medical ideas that people can put the slider all over and have a good dig around. So thanks again, and hope you have a great Christmas and a New Year. And hey, just keep up the marvelous work, because your portfolio is doing must put a big smile on shareholders. So thanks again, Richard.
Thank you ever so much. Thank you. Good luck, everybody.
Thanks a lot, Richard.